Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the November FOMC and the speech given by Chair Jerome Powell at the meeting following. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. You can find a link to that in the description below or in the pinned comment. Let's go ahead and jump in. Now, a couple of days ago, we put out a video suggesting that the Fed is unlikely going to become super dovish at this meeting because of unchanged data. For instance, the unemployment rate remains at historic lows, coming in at around 3.5%. Furthermore, core inflation is still putting in new highs as recently as last month. Therefore, we should not expect there is a compelling reason that the Fed is at a point where they are going to pivot. Despite this, there was a common narrative going into today's meeting that the Fed was going to pivot because of political pressure. However, you could argue that Powell has quickly distilled of that theory and is suggesting that the Fed is prepared to continue rate increases. Now, there are a few quotes that I do want to talk about before we get too far into the data. We are focused mostly on the data, but I do think there are some things that Powell said which could at least give us some insight into what they're thinking. And that way, as we get closer to the December meeting, we can remember that all the narratives that are going to pop up right before it don't necessarily mean anything. And we should always go back to what did Powell say and has the data actually changed? So far, sticking to the data and the fact that unemployment has remained low and core CPI has remained high continues to suggest ongoing rate increases at similar levels that we've seen. We have now seen our fourth 75 basis point rate hike in a row. Now, the first thing we should talk about is the press release. So this was actually released at 2 o'clock. And the first thing to note is that they raised the federal funds rate up to 3.75% to 4%. So this got the Fed funds rate up to 4%, which distills of the commonly thought of theory that the debt to GDP ratio would prevent them from going above 3.5%. I've suggested for a while that I do think there's a good chance the terminal rate could be between 4 to 5%. However, I will argue there is a chance, a non-negligible chance, that the rate ends up going above 5%. I'm not saying it's necessarily the most likely case, but there is a chance that it happens, and we'll also talk a little bit about that in this video as well. So the Fed funds rate is now sitting at 4%, but initially markets started to pump. If you go take a look at Bitcoin, which arguably is a good measure of sort of the high-end risk, you can see that initially we sort of had a brief fake out, and then we went back up to the upside. Well, why did we go to the upside when we just got a 75 basis point rate hike? One could argue that it was expectations, and then a lot of times you just got to get the report behind you, and then the market will pump. But I think the more likely scenario that caused the initial pump is this sentence in here. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, and inflation and economic and financial developments. So this is what they said in their press release, and it got the markets pumping. Now, I do want to talk a little bit about some of the quotes by Jerome Powell. I'm not really used to just reading things off the screen on this channel. We normally stick to the data, but I do think this is a sufficient reason to really go into what is Powell thinking. So I'm going to read you a few quotes, and might be kind of boring, but I do think this is important. So some of the first things that Powell said today in his meeting are, let's see. Without price stability, the economy does not work for anyone. So he's talking about as long as inflation stays high, the economy just simply isn't going to work. We still have some ways to go. Incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. That's quite a big statement, right? That's a big statement for him to say. Let me say that again. We still have some ways to go. Incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. What data is he talking about? Well, again, core inflation's going up. Unemployment has recently gone back down to 3.5%. So again, if you stick to the data, which is what they're doing, you could arguably have some insight into what they're going to do at future meetings. Now, the counter argument is that they're looking at lagging data, and I'm not going to dispute that. But I think the The smarter play in this situation is to not just say, well, it's lagging data. It's to say, well, you recognize it's lagging data, but it doesn't matter. That's what they're using anyways. Okay, so I think that's an important consideration when you talk about like the unemployment rate and you talk about rising core CPI. All right. He says, we will stay the course until the job is done. And here's another interesting statement that Powell made today, because this also is a common theory I've seen recently that have suggested that Powell will pivot, and that is that there is a risk of doing too much and hurting the economy. So it's the idea that, do you want to risk doing too much and harming the economy too much? And he addressed this. He says, if we were to over tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we are in a situation where inflation will become entrenched. So this is an interesting statement made by Powell, and I don't 100% agree with it, to be completely honest, because what he says, and I first of all, I will say I do think they're doing the right thing by continuing to raise interest rates, and I understand that people are angry. I understand that a lot of people are in denial, but QE is a hell of a drug. And it's hard for people to give it up without going through some of those common responses. But the thing that I don't necessarily agree with is not saying whether they'll over tighten or not, but they say that they have the tools to strongly support the economy if they do over tighten. But the counterpoint to that is, and I would be nice if a reporter were to ask him this: what happens if they over tighten and the economy gets absolutely wrecked and inflation is still high? So it would make sense that if the economy is doing really, really poorly, then inflation would go down. But we also know that there is a lag in that. So I think that is why, again, going back to their press release, is why they say this, is that they understand that that they have to take into account the lags. So you could argue, though, that what happens if they do over tighten, which I don't think they've over tightened yet, to be completely honest. But what happens, especially with where inflation is, but what happens if they over tighten and inflation still has not come back down? Do they have the tools to support the economy or not? And it could lead to a fairly nasty recession. What are you going to do if inflation's at 4 or 5% and the unemployment rate is at like 5% or 6%, is going higher, and inflation still has not come back down? The counterpoint to that is to say, well, if the economy is getting wrecked, inflation should come back down. But again, there is a lag there. So this is an important thing to think about. And it goes to show that Powell is more so leaning in the direction of over tightening than under tightening. Why is that? Well, he addressed this many times. If you don't tighten enough, so let's say they just stop right now, then risk assets could start to rally again. And you see some type of loosening of monetary conditions, and then inflation starts to become even more entrenched. And then in a year or 2 years, then you have the problem, and now it's a lot worse because inflation has been running rampant for 2 years, which is not actually helping the people that they're trying to serve. So I think it's more likely that they're going to continue to remain hawkish. He says we don't want to make the mistake of failing to tighten enough or loosening policy too soon. And he goes on to say it is very premature to talk about pausing our rate hikes. We have a ways to go. So again, he completely distills of the theory that the Fed is about to pivot. And again, for me, a pivot at the very least is they have to pause rate hikes. They're nowhere close to pausing rate hikes. He says they have a lot of ground to make up. He did suggest that, as he suggested before, they will slow the rate at some point. But in his speech, he says that it could be next meeting, but it also could be the meeting after that. And the meeting after the next one, I believe, it's not until like late January, early February. So, that's still a little ways off here, okay? Because we have the meeting in like mid-December, and there's not another one after that for another month and a half or so. So there might not be a 50 basis point rate hike this year. So why would he say that, right? Why would he say that it might not be at the next meeting that they start to slow rates? Well, the same reason he said before at the prior meetings, right? If data does not suggest that it's prudent to do so. If unemployment is staying low and core CPI is staying high, again, last month it came in at 6.6%, which is a new high this cycle. If this continues to go higher and unemployment remains unchanged or stays around the current levels, I think there's a case to be made that we'll just have a fifth 75 basis point rate hike to get the Fed funds rate up to 4.75% by the end of this year. That's something to think about. And he also said that we have some ground to cover with interest rates before we get to that level, which is sufficiently restrictive. There is no sense that inflation is coming down. I have a table of the last 12-month readings. We are exactly where we were a year ago. It was, I mean, yes, there was a couple of dovish things in there mixed in, but he pretty quickly brought that back and said, no, we're going to keep raising interest rates. The data does not support a pivot. Despite everyone screaming for a pivot, the data just simply does not support it. One of the most telling things that he says, this might be the second most important thing he said. The first most important thing, I think, is that the federal funds terminal rate is likely higher than they expected. This is the second most important thing, I think. The window for a soft landing is narrowed because inflation has not come back down. We've talked about this a few times. So if you go look at the S&P 500, and we've previously talked about what would a soft landing look like. I think a soft landing would just be simply a 30% move from the all-time high, right? A 30% move down, because a 30% move down is not it's not as significant as what we've seen in some of the prior bear markets where we went down like 50%. So again, these are hard landings where you see 50% corrections. A soft landing, in my opinion, would just be a 30% correction. So somewhere in this range. Sort of somewhere in between would be a 40% correction, which I think you could argue that there's a strong case that the S&P could end up bottoming around 3,000 if inflation doesn't come back down. I do think that the 3,400 level is sort of the case to be made for a soft landing. 40% down, sort of somewhere in the middle, and then 50% down would sort of get you to dot-com level territory and financial crisis territory. And that would put the S&P all the way down, at essentially 2,400, which is, again, is half off from the all-time high. I don't think that that's necessarily the base case at this point, but there is always a risk of something like that playing out. For now, I think we have to see, can the Fed achieve a soft landing? But so far, as Powell said himself, the data is not supporting that, right? The data is suggesting that the window for a soft landing has narrowed. So a lot of things that he said today that I think are worth thinking about. So how do the markets respond? I mean, first you should probably go look at Bitcoin. It was all over the place, and at first it broke down, then it broke up, then it broke back down, which it makes sense, right? The Fed is hawkish. Risk assets simply are not going to do well in an environment where you're seeing quantitative tightening and more restrictive monetary policy. And this is why we show a lot of indicators, and some of the indicators we look at say that markets are near the low, and then other ones, even when we didn't have a future recession, still say we could potentially fall even further when recessionary fears were not something we had to think too much about. So do keep in mind that the macro environment is important. If the cost to borrow and capital just simply goes up, then it makes it more difficult for risk assets like cryptocurrencies to do well. It doesn't mean that they can't do well during short periods, but the overall trend for 2022 has just been down. Some altcoins even recently put in new lows over the last week or two. Meta, Google, and Amazon put in new 52-week lows today, right? Like even today, they're putting in new 52-week lows. So risk assets are not responding in kind. Why is that? Well, one thing to remember is that if you go take a look at the yield curve, so let's go take a look at the yield curve. You can see that it really is starting to invert, but I mean, you can get fairly attractive yields now. Go look at the 2-year, right? Look at the 2-year yield. It's at 4.6%. This is pretty high. And you might say, well, I mean, who gets out of bed for 4.6%? Like, no one's going to get out of bed for that. The counter argument is, yeah, well, maybe you don't get out of bed for 4.6%, but if you've been buying altcoins during that same period, if you go look at, say, Total 3, which excludes Bitcoin and Ethereum, I mean, it's mostly been a downtrend for this year. I mean, yes, you could argue that recently we've just been sort of holding on to the lows, but if you've been YOLOing into altcoins all the way down, you're not really doing that well. I mean, let's just take it, even if you bought in over here or something, you're still down like 40-50%. So yeah, like it's difficult to sort of get excited about a 4 to 5% return, but it's quote unquote risk free. Nothing's really risk free, right? But this is just, these treasury yields you can actually get, or these treasuries, you can actually get yields that you are fairly certain you're going to see, and not something where you're taking on some speculative bet where you're fighting the Fed. All right, this is why they say don't fight the Fed. When the Fed is going through a period of QT, you just simply don't generally want to fight them, because you're fighting a very difficult battle. A lot of people want to fight them, as you can see with all the counter trend rallies that we've had, but at the end of the day, we haven't really gone anywhere in any sustainable way at this point. So this is certainly something that is worth continuing to follow. And remember, as yields go up, 4 to 5% relatively risk-free can be a lot more attractive to people with a lot of cash. They might just put it in there and say, to hell with risk assets, I'm just going to put my cash into into some 6-month CD or something like that, and just wake me up in Q2 of 2023, and maybe the market will look better, and maybe then they go into the market, right? So just something to think about. As the yields go up, more and more investors are going to start not finding stocks attractive, and they're going to start finding this more and more attractive. But what's funny is, as this finally gets into the point where it peaks, you're likely going to see stocks at some point over the coming quarters hit some major bottom, and that's where the true money will be made for the next cycle of economic expansion. We've talked about this a lot. If you go look at the NASDAQ, a lot of people look at the NASDAQ and they look at what's going on right now, and they get super fearful because of how bad it looks. And I would agree, it looks pretty dismal, and it's likely going to continue down. A lot of these major tech stocks have just been continuing to go lower, and you can compare it to the .com crash, where it went down a lot, but that's not really what I look at, right? Yes, this sucked. Not for the people that got in over here, right? Like, not for these people. Not for the people that just said, yeah, like cash is king in the bear market, and then they waited for everything to sort of like settle down, and then you get in. Who cares if it took a while to get to a new all-time high? It's not like you had to wait for a new all-time high to make money. I mean, if you were buying tech stocks in 2003, 2004, it was still an uptrend. Yes, we had the financial crisis, but even then we recovered, in short order and continued to push higher. You didn't have to wait, 10 years or 15 years to see gains. You would have been experiencing gains this entire way. And that's why I say it's always important, the relative area. It only matters a lot if you put all your money into the market at the all-time high. If you are patient, or you slowly DCA into the market, or whatever strategy you have, as long as you keep some cash on the sidelines, you reserve the right to remain somewhat flexible on how you want to approach this market. And so that's why I think that those that have been able to have a cash position this year will find relatively good deals relatively soon. Okay, so you keep this in mind as we continue on. And then I believe the only other thing I want to talk about very briefly, I believe, is core CPI. I do think we're going to see a double peak on this. I think Bitcoin might even arguably be a good indicator of that. If you think of Bitcoin as sort of televising exactly what core CPI is going to look like, maybe Bitcoin is a good measure of cheap liquidity in our system. And with all this, we're getting huge inflation readings in core CPI. So this peaked out at 64 to 65K. This went up to 69K. Coincidentally, of course, it's a pure coincidence, but coincidentally, core CPI peaked out at 6.4 to 6.5, and then now maybe going to be going up to like 6.8, 6.9 before finding a double peak. I do think there's a good chance core CPI is going to peak out within the next 2 to 3 months and start a somewhat slow downtrend in 2023. And by the end of 2023, by mid 2023, I do think the Fed will be done raising rates, and they'll probably pause for a while, and then potentially they'll start rate cuts by late 2023 or maybe early 2024, just in time for the next Bitcoin halving. So a lot of interesting things to continue to think about with how far ultimately will the Fed go in their fight against inflation. Powell says they're going to do it until the job is done. He says they're going to do it until inflation's back down to 2%. The common narrative is that they're going to change that to 3 to 4. But every meeting I've heard him talk about it, he always says their goal is back to 2%. So I'm going to continue thinking that until the incoming data changes, until unemployment goes up, until inflation comes down, the Fed is likely going to remain hawkish. And if we go take a look at the sort of the projections for December, you can see that it's sort of split. Right now, there's about a 57% chance we're going to see a 50 basis point rate hike and a 43% chance that it'll be a 75 basis point rate hike. So right now, the markets are saying, it's somewhat 50-50 with a slight edge towards a 50 basis point rate hike. So again, is there a chance the Fed raises by 50 basis points in December? There is. Will they raise by 50 basis points in December if inflation has gone up and unemployment has gone down or stays the same? Probably not. They could easily raise by 75 again. And again, he did say they might not raise, or they might not cut it down to 50 until the following meeting, which isn't until early 2023, after the one in December. So you can see it's on February 1st. So something to think about here. If we continue on, if you go to February 1st, the general expectation is that we'll be at 5% by that time. By March, 5.25 is sort of the highest expectation. By May, still 5.25, and then even by June. So this hasn't even really adjusted that much, which I do find somewhat interesting, considering that he said that the terminal rate will likely be higher than what they generally thought back in September. I don't really think markets have fully priced that in, and perhaps the reason why is because the markets are simply going to wait until November 10th to see the most recent core CPI data. So that'll be some interesting data to come in. We also have unemployment data coming in relatively soon as well. Plenty of data to see, and we're actually going to have two readings on core CPI and headline CPI before the next meeting, right? We're going to have the one in November, but we'll also have more CPI data in December as well. So again, there's a lot of uncertainty there as to whether the Fed's going to do 50 or 75. I think Powell did what he needed to do to sort of temper expectations. So he's saying, like it could be 50, but you need to be prepared that it could be 75 for the fifth time in a row. And the way that we get to a fifth 75 basis point rate hike is if inflation keeps going up while unemployment remains relatively unchanged. And so far, risk assets just simply do not like it. And as we've said, they will remain under pressure as long as the Fed continues on, likely with its quantitative tightening policy. And until they shift that and we actually get a real pivot and not just some made up pivot by people hoping that they'll pivot, then we can probably actually start talking about, all right, we're likely getting somewhat close to a major bottom, especially on things like the S&P 500, the NASDAQ, etc. That'll wrap it up for the video. Remember to check out the sale on Into the Cryptoverse Premium, intothecryptoverse.com. We have 3 premium videos per week, a newsletter. We have a website with all sorts of data that you can access. Check it out, lock in the lower rate as long as you do not cancel. You can, again, find a link to that in the description below or the pinned comment. Thank you, guys. I'll see you next time. Bye.